This is the map of China's Belt and Road Initiative, which is President Xi Jinping's signature policy that aimed to develop one of the largest international infrastructure projects ever, connecting China to countries as far as Greece, Luxembourg, and Kenya. So far, China has invested a total of $932 billion for this massive project, consisting of $561 billion in construction contracts and $371 billion in non-financial investment. But 60% of the entire loan portfolio is at risk of default right now, compared to 40% at the end of 2021, as if 40% wasn't already bad enough. In other words, China has found itself in the middle of an international debt crisis. Now, many of the countries involved are developing countries with the worst credit ratings in the world. Here, the red line represents the ratings of Chinese lending portfolio, and the black line represents the weighted average ratings of EMDE as a whole. As you can see, the red line has fallen since 2013 to B- or just above non-investment grade. And this also implies that the Chinese loan portfolio is much riskier to begin with compared to the average EMDE credit ratings. Through the Belt and Road Initiative, China has built important infrastructures like railways, oil pipelines, power stations, and ports all across the world. The project involved 149 countries and 32 international organizations, impacting 65% of the world's population and affecting 3/4 of the known energy reserves in the world. It's quite an ambitious project. So today, we will examine the Chinese Belt and Road Initiative, break it down both by country and sector, look at the inflows and outflows of capital, and finally, we will look into China's international debt crisis and what it means for China and the global economy. Okay, so the first thing that we need to understand is about why China wanted to undertake such a massive project in the first place. Well, one main reason is influence. As the China-US rivalry is still ongoing, China wants to create its own secure trade routes with nations that are not directly influenced by the US. And at the same time, China also hopes to make participating nations more dependent on the Chinese economy, in order to build its economic and political influence. Another key reason is the legacy of the 2008 financial crisis. You see, China's government responded to the crisis with a 4 trillion yuan of stimulus packages, issuing contracts to build railways, bridges, and airports. But this saturated the Chinese domestic market in the process. As productive investment opportunities began drying up, China began to look outside the country for opportunities to invest. Fortunately for them, there are still a lot of developing countries out there that desperately need infrastructure investments but don't have access to international development lenders like the World Bank. This is where China comes along and offers loans to these countries. We can also say that China wants to avoid what is known as the middle income trap, where middle income countries like China, which depends on manufacturing and exports, lost their competitive edge as wages rise. That results in the country failing to transition to become a high-income economy and is stuck as a middle-income country. So, the Belt and Road can be seen as China's attempt to open up to other export markets and therefore avoid or at least delay the middle-income trap. In all of these aspects, the Belt and Road is very similar to the Marshall Plan that followed the Second World War. The Marshall Plan was an American program designed to provide aid for the reconstruction of Western European cities, industries, and infrastructures that were destroyed during the war. Of course, the US didn't do this purely because of benevolence. The plan benefited the US as well in the forms of increased influence in Europe, provided good opportunities for investments, and opened new export markets for US manufacturers. So you can think of the Belt and Road Initiative as China's version of the Marshall Plan for the 21st century. Okay, so those are some of the underlying reasons. But if we look deeper into the numbers, what actually happened was that China has invested most of the Belt and Road money into the energy sector. You can see it in this chart here. When the project first began in 2013, China invested more than 50% of the Belt and Road budget into the energy sector. And while China has reduced its investment in energy since 2020, it still represents 42% of the entire Belt and Road portfolio. China has stated in Chapter 51 of its 2016 5-year plan that they want to gain access to natural resources around the world. The second largest sector that China invests in is transport, consisting of 31% of China's Belt and Road portfolio. These are things like railroads, airports, and ports to connect the dots and build a new trade route. The third is commodities like metals, and the fourth is real estate. Now, as China's main interest in the project is about energy, naturally, countries that had the most share of Chinese investments are resource-rich countries. And for this reason, the country that has the most Chinese Belt and Road loans is actually Russia. This might sound surprising to onlookers, but it's not so surprising if we understand Beijing's motives. They try to develop a strong relationship with these resource-rich countries to develop that sector in those countries, but also to make sure that they have plentiful access to those natural resources going forward. Russia has the most Belt and Road loans at around $300 billion. The second country with the most Chinese loans is Qatar with $250 billion, then Saudi Arabia with $100 billion, United Arab Emirates with $75 billion, and Nigeria with $60 billion. Again, all of them are countries rich in natural resources, especially oil. Now, the thing with energy sector investment and infrastructure investment in general is that they are very long-term projects. It takes a lot of work to build things like railroads, power plants, and oil pipelines, especially when we account for regulations, environmental safety concerns, social disruption, etc. Even if the project is well planned and well executed, it may take years for the project to break even and finally yield positive results. It's only been 10 years since the Belt and Road Initiative was first designed and launched, so we cannot judge whether Chinese investments are good or not just yet. And although Chinese investments has mostly benefited countries that participated in the Belt and Road project, there are several criticisms that come not only from rival countries, but also from countries that receive loans from China. Many projects are coping with project delays, environmental problems, and a lack of local worker participation. You see, as most projects are built by a Chinese workforce that is shipped in specifically for the project, there is no employment benefits for those countries and there's no transfer of skill to the local workforce. This is most evident in African countries where youth unemployment is particularly high. Moreover, according to a Washington-based consultancy, 32% of the total Belt and Road projects have run into trouble like delays, cancellations, public opposition, mismanagement, corruption, and national security concerns. Finally, there is the debt sustainability issue. The IMF has repeatedly warned that China is supporting unneeded and unsustainable projects in many countries, leading to heavy and unpayable debt burdens. Sri Lanka is a prime example of this. China has become the largest lender to the country, holding 10% of its total foreign debt at $55 billion. The famous Hambantota Port and the Lotus Tower, one of the tallest buildings in South Asia, are now considered as malinvestment. You see, infrastructure spending is actually a cost of growth, not the cost. A project can only be justified if it's increased worker productivity more than the cost of building said infrastructure. If not, then infrastructure spending will actually halt economic growth. Both the Hambantota Port and Lotus Tower do generate employment and economic activity when it was being built, but now they turn out to be a waste of time and money, a malinvestment. As Sri Lanka couldn't pay its debts, its $1.1 billion debt was written off in exchange for a 99-year long-term lease on the Hambantota Port, and the country is now in shambles. Many have pointed this out as a prime example of China's debt trap diplomacy. Although to be fair, Sri Lanka's government incompetence do play a big part on this whole mess. And then there's Russia, which is the biggest Belt and Road loans recipient. As you've certainly known, Russia's economic conditions is pretty bad right now thanks to the war on Ukraine and the sanctions that are being put on them. This chart from the Financial Times shows China investments in Russia since 2013. Up until 2019, China still invested heavily in Russia. But in 2020, investment has fallen significantly, presumably because of COVID and the subsequent lockdowns. And because of the war, there is no Chinese money flowing into Russia in 2022. Now, China actually still depends heavily on Russian natural resources. 15% of all oil and 8% of all gas used in China is supplied by Russia. But as Russia's credit ratings have been downgraded by pretty much all rating agencies to non-investment grade status, we saw China diverting its funds to other oil-rich countries like Saudi Arabia and Qatar. Early this year, China agreed to a set of deals with Saudi Arabia amounting to $5.5 billion worth of investment. And last year, Qatar was the single biggest beneficiary of Belt and Road investment with around $10.5 billion worth of contracts signed. But besides Russia, whose economic conditions have deteriorated, China's loan portfolio is already pretty fragile in the first place. By piling its money into developing countries in the Middle East and Africa, China has positioned itself in a tough place. This chart from the FT shows that the majority of Belt and Road countries are classified at number 7, which is the highest possible risk level. A lot of countries that receive loans from China like Pakistan, Argentina, Belarus, Egypt, Mongolia, Nigeria, Turkey, and Sri Lanka all have a credit rating of junk. And here, you can see a growing number of loans that had to be renegotiated since 2020 amounting to $52 billion. In my opinion, this happens because China overestimated the growth rate that these developing countries could get. We must remember that when the initiative was first launched in 2013, the rest of the world had mostly recovered from the 2008 crisis, and the global economy experienced rapid economic growth supported by soaring commodity prices. But as good times don't last forever, China has positioned itself in quite a tricky situation, as it holds a basket of a concentrated portfolio of developing countries amidst an economic downturn. So now, China has to make a tough decision. It can choose to walk away, stop investing, and try to recoup as much interest as possible, essentially abandoning the Belt and Road Initiative, which in my opinion is very unlikely. Or it can take the role of the IMF and provide emergency loans to get countries through economic crises, with the hope that someday these countries will recover and be able to pay back all those loans. Which is certainly hard to do as China still has its own internal problems to deal with. Now, a lot of China's internal and external problems actually stems from one thing. If you want to know what that is, feel free to click and watch this video. This is Doverhill, and see you next time.